Welcome to Savest Financial Services, an investment advisory firm licensed by the Nigerian Securities and Exchange Commission, SEC. As a fiduciary, our primary obligation is to act in the best interests of our clients, providing a solid foundation for wealth accumulation, protection, preservation, and distribution across generations. We assist our clients in navigating global capital markets and diversifying across various asset classes. We proudly serve individuals, families, small businesses, and large institutions, guiding them through complex financial landscapes with unwavering ethics and professionalism. Our commitment to excellence is reflected in our processes, the quality of our team, and our robust ethical standards. Services overview. We serve individuals through 1. Private wealth advisory. 2. Ethical investing. 3. Wills, trust, and estate planning. We serve family offices through 1. Multi-generation wealth planning. 2. Family governance and succession planning. 3. Family business advisory. 4. Asset protection. 5. Multi-jurisdiction tax planning. We also provide strategic guidance to institutions including small businesses, foundations, cooperatives, and fund managers through 1. Optimal resource allocation. 2. Asset and liability management. 3. Cash flow optimization. 4. Establishing an adequate governance structure. 5. Model portfolios. For more information or to speak with a professional investment advisor, contact us at +234 913 446070 or visit our website at www.saves-financial.com. Follow us on social media for updates: Instagram at Saves Financial, Twitter Saves Financial, LinkedIn Saves Financial Services, Facebook at Saves T Financial.
Hello and welcome to the Savest Financial webinar. I'm your host, Chidalu Echem, and I want to thank everybody for joining us today. It's always great to connect with you, and welcome to the second half of 2024. Our topic today is Savest Mid-Year Report and Outlook, and we're going to be having in-depth discussions on the Nigerian and global capital markets, highlighting opportunities and risks for portfolios. During this live 1-hour event, we're going to dig into key issues that are on your mind, such as how are the year-long Tinubu economic reforms shaping the Nigerian capital markets? How is artificial intelligence and other trends driving the global capital markets? How will elevated inflation and interest rates create opportunities for income and portfolio diversification? And most importantly, what are the local and global opportunities for navigating these tough economic times? So we're going to answer those questions and your questions during the next 1 hour. And we have a great speaker with us to help us break it all down. But before I introduce him, let me cover some housekeeping details. Now, if you look in the chat box, you're going to find our disclaimer pinned, which says, no information given here should be construed as investment advice. Investing carries significant risk and requires the professional advice of a competent investment advisor. The advice that some members of our firm hold investments in some companies mentioned in this webinar or reports. Additionally, we have some of these positions in our model portfolios. This information is provided for transparency and does not constitute investment advice. In addition, this mid-year report will be available for download on our website, www.savest-financial.com, at the end of the webinar. Click on the resources section and then on the webinar tab, and you'll get access to the documents. Alternatively, you can scroll down to the footer of our website and you'll see the webinar tab. I encourage you to download this report and go through it after this webinar. Also, we love getting your questions and comments throughout this event, so feel free to use the Q&A box, and we're going to try to answer as many as we can. Okay, with that, let me introduce our speaker. Nathan Nwokoro is the Chief Executive Officer of Savest Financial Services Limited, a corporate investment advisor licensed by the Securities and Exchange Commission. With over 17 years of experience in the financial services industry, Nathan began his career at Zenith Bank PLC, and then went on to Cowrie Asset Management Abuja, where he covered wealth management, fixed income sales, transaction advisory, and business development. He's a member of the Investment Committee Council for various institutions. Nathan is a visionary leader with an unwavering commitment to excellence and client satisfaction. He's a chartered financial analyst and a member of the CFA Society of Nigeria. Nathan, thank you for taking the time to speak with us today. It's great to have you.
Thank you, Chidal.
Okay, let's jump right in. Can you give us a brief insight on what to expect from this report, or what's the big picture outlook? How are things shaping up at this point in the year?
Okay, I'll start by referencing an encounter that was credited to JP Morgan. And in this encounter, an acquaintance asked him, what will the market do tomorrow? And he said, it will fluctuate. And that kind of underscores what we have to constantly deal with as investors. We always expect a linear market where we have less uncertainties, less volatility. That is the outcome most investors would desire. But the reality is that uncertainties is an indispensable part of the market. And as investors, we must learn to not only live with them, but to invest through uncertainties. And for me, the big picture today is having that long-term view that allows us not to overweight short-term sentiments in our decision-making. So for me, it's all about having, looking to the future and having a long-term view that aligns with one's investment objectives.
Okay. Thank you very much, Nathan. All right, so moving on, we've had global inflationary pressures that has been followed by pandemic disruptions, supply chain issues, and geopolitical tensions, which have, of course, eased in many countries like the US, Europe, the sub-Saharan African countries like Ghana, Kenya, Egypt, and co. Now, however, Nigeria stands out as one of the most notable exceptions, as we've seen headline inflation continually rise to the current level of 33.95% in May 2024, which is 91.7% higher than the rate recorded for the same period 2 years ago. Now, what factors do you think explain this disparity? Also considering the policy responses that have been implemented by various countries and the specific circumstances in Nigeria.
Okay, to start with, Nigeria has, over the long term, had a much higher inflation than most of its peers. So if you look at the last 30 years, inflation in Nigeria has averaged around 13.56%, compared to South Africa, which has a long-term inflation trend of 8.65%, and Kenya that has 8.7%. And of course, in advanced country, that figure is much lower. For instance, US is 3.3%. So over the years, Nigeria has had this high level of inflation that affects us. But in terms of the recent round of higher prices, it started with COVID, and then the war in Ukraine that led to food and energy prices getting elevated. While we're trying to get out of that, which was something that affected most countries in the world, we had a new administration in 2023, Tinubu's administration, that came with a couple of reforms First was the liberalization of exchange rate, the removal of fuel subsidy, and then the removal of electricity subsidy. So these reforms led to higher prices in food, energy, and electricity. And you agree with me that these are very important consumer products in Nigeria. And it kind of took Nigeria's inflation to a different level. And even though that trend is starting to ease a little bit, what we are still seeing today is more of food inflation. If you look at the last number that was published by the Nigeria National Bureau of Statistics, food inflation was at 40.66%, compared to the headline inflation, which was 33.95%. So food inflation is one aspect of the Nigerian inflation that remains sticky up to date. And the hope is that that number will come down progressively. And if I must say, one factor that is contributing to, or rather two factors contributing to food inflation is exchange rate and farmer headers crisis. And we've seen on one hand, the central bank, most of the central bank's effort is actually in bringing down or stabilizing exchange rate, which is essentially what is within the only tool practically that they have in bringing down inflation. However, stabilizing exchange rate through higher interest rates, which is aimed essentially at attracting foreign investment and foreign currency into the country, it's not enough to bring inflation down to a single digit, which is where CBN would love to have it going forward. We also need some fiscal response to it. I guess we are starting to see that with some of the efforts from the federal government, but we still need a lot more in terms of fiscal response to inflation. The Ministry of Finance, I think at some point at the early part of this administration, attempted to raise taxes because essentially inflation means that you have a lot of money chasing fewer goods. But the situation in Nigeria is a bit peculiar because it's not necessarily a lot of money chasing few goods, because according to classical economics, if you have this situation and you want to address it with raising rates, it's expected that the economy is producing near capacity. But that is not the case of Nigeria. We are producing far below capacity because of disruptions. Farmers are not able to get to their farms. We have these exchange rate issues. Essentially, what the central bank is aiming to do with raising rates is to attract foreign investments in form of open market operations, attract foreign currency into the country, and then hoping to stabilize exchange rate and then moderate full inflation. But that alone will not be sufficient. We also need some sort of response from the fiscal authorities in terms of curtailing its own spending, his own appetite, his own consumption appetite, to lower demands and then moderate inflation.
Let's speak to the US economy. While US economy appears resilient and it has been driving global growth, what do you think are the key risks or uncertainties we should consider in the second half of 2024, especially regarding the potential impact of the Fed's interest rate decisions and the upcoming presidential election?
Okay, I think most analysts have spoken about the resilience of the US economy, and it's not hard to see why the economy is that resilient. It comes from strong consumer demand, consumer spending that started with the the stimulus plan that was executed by the US government in 2020. And that has kind of kept impacting on the economy all through. Then you also look at unemployment rate. Even at 4.1%, unemployment remains within a manageable range. And of course, the strength of the US economy that is projected to grow at 2.7%. Of all the major economies, that is one of the strongest compared to their trend rate, their long-term trend rate. So in spite of all of these uncertainties, all of this crisis, in spite of inflation, the US economy is still growing above the trend rate. And that is where the strength comes from. So for the Federal Reserve, if you listen to Powell speak in recent weeks, he has kept talking about the numbers. These numbers are looking good. Inflation is coming down. So for them, the risk is two-sided: cutting rates too early or cutting rates too late. Now, if you cut rates too early, what can happen is inflation may reverse, and then that will create a whole lot of chaos in the market. Or cutting rates too late. And if you cut rates too late, it means that you allow the economy go into a slowdown that it may not recover from soon. But for them, I think they would rather cut rates too early than cut it too late. Because if you cut too late, if we get a slowdown today, it is something within the range of expectation of the market that we should get a slowdown. It's even a miracle that the major economies are performing at the level at which they are performing today. So I think for them, it's not cutting rates too early. So I think it's a waiting game. They're going to wait to see that inflation comes down to the target band, which is around 2%. And while waiting, the hope is that the economy, the numbers that comes out in this month while we are waiting, remain strong. But in terms of the upcoming election, the market has seen a Trump presidency and a Biden presidency. And I can say the market loves both of these guys. If you look at the charts we have, one of the charts we have here, the market did well basically under both administrations. But the difference between them will be in terms of their foreign policy and how it impacts the market. And two aspects that the market is looking at majorly is immigration policy and in terms of the trade war with China. So on the part of Trump, he's proposing to deport about 8 million illegal immigrants in the US. And that's, if you look at, I started from talking about the strength of the US economy, which comes also from their labor force. The US has one of the strongest labor force among the major markets, and that comes from their immigration policies. They have a healthy immigration policy that ensures a constant stream of workers. Now, taking 8 million workers out of the economy will definitely have impact on sectors like hospitality and possibly healthcare. And then again, he's also proposing additional tax on China. And as we know, protectionism is not always good for the market. So in terms of risk, these are the major risks that the market is looking at. And then on the part of Biden, I think the major worry is his health, his ability. Can he do another 4 years and be in charge as much as he has been this past 4 years? So we'll be looking at how both of these play out in the coming months.
Okay, Nathan, from what you said, it seems based off the upcoming election, the presidential election in the US, we may not see so much movement in the markets because, like you said, the market has seen both candidates. So there isn't much news that's going to shake the markets based off that. But let's move from there to the geopolitical risk we're seeing, especially in the Middle East. we've seen a potential for a wider conflict on the Israel-Hamas front. And we've also seen the impact of the war in Ukraine and how it has impacted or compounded inflation. So how do you weigh the possible short-term disruptions against long-term investment strategies?
Okay, I think geopolitical risk is another factor that investors sometimes overweight. However, the impact of geopolitics is often short-term lived and has less impact on the market outside the area where the conflict is going on. So if you look at the Israel-Hamas war, it's been on since October 7th last year. And the fear has been from a broader crisis in the Middle East. So far, that risk has been curtailed. But with the emergence of the conflict between Israel and Hezbollah in Lebanon, there is fear that it may draw Iran into this war, which may cause some supply disruptions. Yeah, but then if you look at Iran accounts for only 4% of the global oil production. And Iran itself is dealing with its own crisis, economic crisis. Trump imposed some sanctions on them back in, I think, 2018 or so. They're also seeing high inflation and currency crisis. So war is one thing that Iran would prefer to avoid. So in my opinion, why the risk is still there that this crisis may broaden in the Middle East, it's not a first time. We've seen conflict between these two parties. I think it will manage and may not impact the market so much. So I think the impact will be very minimal, even if there's an escalation on that front.
Okay, so we won't see the sort of impact we had from the war in Ukraine. You're saying we won't see that sort of impact in this case?
And I doubt that.
Okay, you've talked about Nigeria, and while we see these inflation figures or these high inflation figures and fiscal deficits across sub-Saharan Africa, in Nigeria, we've had series of reforms that have been initiated by this Tinubu's administration from the 1st of June 2023, if we can recall, from the removal of fuel subsidy. Then other reforms have followed after that. But can you give us an overview of the Nigeria's economy under this current administration? You can speak to market confidence and the overall economic outlook.
Before this administration came into being in 2023, the president promised to hit the ground running. And that was what he did exactly. He came in with all of these reforms, which I had mentioned earlier on, the liberalization of exchange rate, the removal of fuel subsidy, and removal of electricity subsidy, and a couple of changes, particularly from the CBN's perspective. We moved to a more orthodox we moved to a more traditional monetary policy regime. And it kind of restored a lot of confidence in the capital market, because the market for long has been depressed. The Nigerian capital market has been depressed for long. And one thing the market was yearning for was for these reforms to happen. And immediately they were announced, we saw the excitement that returned to the market right from the first month after these policies were announced. So, but then these policies came with its own pains, and we were promised that inflation went to a whole new level. Businesses, in fact, you've seen a couple of businesses shut down operations in the country, but especially small-scale businesses. We often talk about the big businesses, but we're not talking enough about the small-scale businesses that are suffering from these policies. So there's been short-term impact businesses on households. We've seen purchasing power of families dropped drastically, prices of goods off the chart, fixed salary earners. We're talking about minimum wage of how much? 60% or thereabout. That can't even buy a bag of rice today. So there are short-term pains that we're feeling as families, as businesses, and even as a government, because borrowing cost has soared even from the government's perspective. They are borrowing at 20%, 20%. So everybody has kind of, there are short-term negative impacts from these policies. However, these policies were very necessary because it appeared at some point that the country was going to hit the wall anytime soon if nothing was done. And the Tinubu's administration did what needed to be done. But then monetary policies alone, these reforms, for it to bear the long-term fruits that we desire, we need some fiscal reforms. And one thing, I mentioned this earlier, we need what I'll call consumption reform on the part of the government. We do not always have justification for how we spend money as a country. So we have on one hand these reforms, and then of course it's expected that we had savings from the removal of fuel subsidy, the removal of electricity subsidy, that government savings would increase. But the question is, how do we deploy these savings? Are they deployed to productive sectors? Are we using them to build infrastructures, road, improve security? Those are the issues. And then again, Nigeria's economy is heavily dependent on oil production. At 1.25 million barrels per day, it won't cut it for if we really need to achieve the long-term stability that we desire to achieve. Oil production needs to go up to at least 1.8 million barrels per day. Now, so on one hand, there are short-term consequences for these reforms, but largely it is the right move. But on the part of government, a lot of work needs to be done, especially from the fiscal angle. The monetary authorities have done very well, I must say. We recently saw a report from the National Bureau of Statistics that said capital importation increased by 198%. Even though 62% of that came from foreign portfolio investment, as opposed to foreign direct investment that we prefer. Foreign direct investment was just $3.5 billion. Sorry, 3.5% of the capital importation we saw in the first quarter of the year, just 3.5%. That number can be higher, but if we don't see reforms in the fiscal space in terms of a better operating environment for businesses, some of these the benefits, the excitement we are seeing in the market today may be short-lived.
Speaking to the reforms you talked about that this current administration has been implementing, the CBN announced their goal of achieving a $1 trillion economy by 2030, which is also part of what this administration aims to achieve. And on that, they announced bank recapitalization. So with this recent CBN efforts, what do you think are the key challenges and opportunities for the Nigerian banks?
Okay, so as I did say, the central bank under Cardoso has done well in terms of fulfilling its obligation and responsibility to the Nigerian people. Because think about the responsibility of the central bank is to achieve price stability, and they are pulling all the right buttons to make that happen. And then achieve stability in the financial system. But then that stability in the Nigerian financial system was compromised by the sort of devaluation that we saw, steep currency devaluation, and then weak economic growth that kind of depressed the value of the financial ratios of these banks. So what CBN is doing is to shore up the capital base of this bank to make them better positioned to carry out their responsibility, which is to mobilize savings from the economy and then transfer these savings as credit to the private sector. At 25 billion capitalization, the banks will hardly do that. So the CBN is saying, show up your capital base, but then they challenge the banks. To me, the challenge that we're facing is a poor macroeconomic environment because let's say these banks, some of them are required to raise up to $500 billion, some up to $200 billion. If they end up raising this money, they need to deploy these monies as credits to the private sector. And from deploying these credits, the private sector is expected to generate profits and then make increased savings in the economy in a way that will transform the private sector and then by extension, the economy. Because for your GDP to grow, you also need to increase national savings that comes from the businesses that operate in that country and the people as well as the government. National savings is a very important aspect of economic growth. So, but if we have the sort of macroeconomic environment that we have today, businesses will not be able to generate profit, repay their loans, and ensure the stability of the banking sector. Now, if you cast your mind back to 2008, 2009, after the financial crisis, bad loans suddenly ballooned in the banking sector. So the banks will be careful after raising this money, how they deploy their new capital base. So the question is, are the banks going to lend to the private sector or are they going to lend to the government? Now, if we have a better macroeconomic environment, then you'd expect them to lend to the private sector. But if things continue the way they are, if we keep having these high inflation numbers, weak economic growth, insecurity, instability in the business environment, then I think the bank would not want a repeat of the crisis they faced in post-2008, 2009. They would rather go lend to the government, crowd out the private sector, and then we are back to the same starting point where in this circle where we have weak economic growth.
So even though the CBN is, according to what you're saying, even though the CBN is putting in every effort, we still need to concentrate on the fiscal side to ensure that there is a balance. Well, we've seen a very comprehensive overview of both the global markets or the global economy. We've also looked at sub-Saharan Africa, and then we looked at the Nigerian economy. I think the question on every investor's mind at this point is, what then are the investment opportunities for navigating these uncertainties? And I think one hot topic that has been there around the world for some time now is AI, artificial intelligence. And it can be very overwhelming for investors to pinpoint what the best investment opportunities are. So can you share some insights on how this AI gold rush can be navigated and sort of identify the companies that are positioned to win, both in core infrastructure and industry-specific applications?
I think AI, the AI trend is one that has established itself as the primary force driving the global capital market. I did make reference to the U.S. economy. The U.S. economy has most of the innovators of the AI trend. And that is part of the strength of that economy because it creates demand for a lot of products, whether from the infrastructure side or from the use case side. But by and large, investors are still trying to figure out the companies that become eventual winners at the end of it all. However, one thing that is clear is that the technology sector is the kind of the sector building the infrastructure, the architecture around which the AI trend is evolving. And undisputedly, that the dominance of guys like NVIDIA is what is generating the current revenue. Because if you're thinking of AI, the question is which companies will have their revenue impacted the most by artificial intelligence, and in the immediate, what we are seeing is that the technology guys who are building these infrastructures are the guys that are enjoying higher revenue numbers since from last year up to this year, and that is expected to continue for at least the next 3 years. So, but then if you look at the AI infrastructure space, there are guys doing different things. You have the hardware guys, which is led, of course, by NVIDIA, but you also have guys like Taiwan Semiconductors that is in charge, that controls about 50% of the chips production globally. You also have the guys providing the cloud infrastructure, guys like Amazon, Microsoft, and Salesforce. They're providing the cloud infrastructure on which the artificial intelligence runs. You also have the guys providing cloud security, which is very important for artificial intelligence, because as more and more critical decisions start happening online, you're going to see hackers trying to compromise the work of these different companies. So cloud security, the importance of cloud security is becoming more and more highlighted as this trend is evolving. So however, for the use case, it's expected that the use case will permeate different industries from healthcare, energy, finance, manufacturing, autonomous driving. But 3 factors that I think are important in determining who the eventual winners are in terms of the application and the use case of artificial intelligence. It's capital, access to consumer data, and access to market. So investors should look out for companies that have these 3 things: capital, access to consumer data, and access to market. If you think of Apple, for instance, Apple for long appeared like they were lagging behind all along. But, Apple has one thing that most companies don't have, and that is access to consumer data. I think they have over 2 billion users on their platform, and that access alone allows them to get into this partnership with OpenAI to deploy it on the Apple ecosystem, to build out their Apple intelligence. So companies that have access to large amount of customers' data and have the capital, because AI is capital intensive, building these data centers requires a lot of capital. So the winners eventually will be those with a lot of free cash flow, access to consumers' data, and then access to the market, which is the number of customers that you have as an institution.
So, like me, I'm sure a lot of people may be wondering, beyond these AI craze, or these, according to the report, they were called, these companies that are in the core infrastructure of AI, they were called the Magnificent Seven. I'm sure some people are wondering, beyond all of these, where else do you see opportunities? Because of course, investors are considering things like maybe stocks that are undervalued, or even for diversification benefits, where else do you see opportunities in the equities market internationally?
Okay, I think the concern for most market watchers is the fact that the market is very narrow. From a risk management perspective, if you look at the concentration of the market in over the last 10 years, it's gotten worse. 10 years ago, the top 10 stocks in the market accounted for 14% of the total market capitalization. That is speaking of the S&P 500. But today, the top 10 accounts for 34% of the total market capitalization. So from a risk management perspective, there will be a lot of concentration, especially guys who are running their portfolio according to the market index. So, but the good thing is that there's expectation that the market will broaden as the economic conditions get better. There's expectation that there will be at least one rate cut in September in the US, and that should start to bring down interest rates and create a better business environment, especially for small businesses, because high rates hurt small businesses the most compared to large businesses, because they are the ones who ultimately need to borrow a lot of money. So there's expectation that the market will broaden as we see stronger economic growth and interest rate comes down. There's expectation that the market will broaden. So I think investors need to look beyond the Magnificent Seven, as you did mention, and start to look at other sectors that are likely to benefit from a stronger economic growth. Of course, some of these sectors are undervalued. So you're looking at the utilities sector, you're looking at healthcare. These are some of the sectors that investors can look to as the market continues to broaden. Then, of course, the international markets, ex-US, speaking of Europe and emerging markets, traditionally, the international market, excluding the US, has underperformed the US market over the long term. However, there are still a lot of strong businesses that are undervalued in the international market. That is excluding US, of course. But however, what we look out for in identifying viable companies in the international market are those with broad businesses that cut across several regions. Companies like LVMH, Louis Vuitton, Siemens. These are companies that have operations across Europe, Africa, and Asia, and even South America. So for us, for investors, there may be some need to diversify globally, not just concentrating in the US market, because the US market itself is heavily concentrated towards the technology sector. And without knowing it, most portfolios are investing along that line, because hardly will you see any portfolio that is not invested in most of these Magnificent Seven: Tesla, Amazon, Microsoft, Google, what is the other names?
Apple.
Apple, of course.
Yeah.
So just by tracking the market, most portfolios are concentrated heavily. So, but however, the good thing is that there are opportunities both internationally and even within the US as the market is expected to broaden in 2025.
Yes. Okay. While we're still on the topic of investment opportunities, let's look at Nigeria. You mentioned earlier that the Nigerian stock market has been one of the biggest beneficiaries of the Tinubu's reforms, as we've seen the NGX has almost doubled. I think it closed at about 100,000 points at the end of the first half of 2024. So where do you think the opportunities still are in the Nigerian stock markets?
Okay, so for years, the Nigerian stock market has been depressed. The valuation has been depressed for a period of about 7 to 10 years. And I mean, if you look at the valuation of most companies today, whether you're looking at the banking sector or the industrial sector or the consumer goods sector, or you're looking at the performance of the all-share index as a whole, most valuations are still cheap in the Nigerian market, even after achieving almost 100% return from last year to this year. Valuations are still very, very cheap in the Nigerian market. And again, you ask why? Why do we have this scenario in Nigeria? First of all, is the weak economic growth. You're looking at the underinvestment by, pension funds. Pension funds have of any institutional investor class, they have the largest asset size, investable asset size. But these guys are allowed to invest, that is the Nigerian pension industry, is allowed to invest up to, I think, 25% in the Nigerian stock market. But most of them are investing less than 10% of their investable assets in the Nigeria market. So they have underweighted the Nigerian stock market for years. We've also seen apathy on the part of foreign portfolio investors. They've also underinvested in the Nigerian market. So in terms of valuation, there's still a lot of opportunities in the Nigerian market. But the question is for many investors is, what is the sustainability of these reforms? Are we going to see them carried over in form of macroeconomic tailwinds to drive the market as the next wave of enthusiasm unfolds in the market? The question again is, will foreign portfolio investors return in their numbers as we saw before the crisis in 2007, 2008? Will pension funds max out their allowable investment limit in the Nigerian stock market? So these are the critical questions that investors we need to find answers to remain in the market. But on our part, we have identified a couple of companies that have managed to remain strong through these years. And we call them the all-weather nine. So we carefully selected these stocks based on their revenue growth, based on their dominance in the sector where they operate, based on their financial health generally, and how they have sustained their business in terms of their competition and revenue growth in the industry where they operate. So to us, to our mind, this class of stocks will be very good for long-term portfolios who are seeking to outperform over a long period of time.
Okay. Can you speak to the fixed income? Definitely, we've seen rise in interest rates, if both in Nigeria and globally, which definitely impacts or influences the fixed income market. So where do you see the opportunities?
Okay, so the fixed income market has become like a darling for many investors, in the sense that we've seen rates at all-time highs, whether you're looking at the local bond market or you are looking at the treasury bill market. There are a lot of fantastic opportunities in this market. The last treasury bill auction we had closed at 20.68%. Even the bond auction for 10 years bond 2033 closed at 21.5%. So it is an exciting time for fixed income investors. But the word of caution here is not to get carried away by these opportunities, because we have a window that will soon start to close. There are expectations that the Federal Reserve will cut interest rates this year at least once, and then have at least 4 rate cuts in 2025. So investors need to be careful, particularly with the treasury bill market, because what you see is guys are going to, there are a lot of investors piling funds into that market. Of course, you can't blame them. The effective yield is 26%. So it can be more attractive than it is already. But the danger is some of these investors will be facing reinvestment risk in the sense that by next year, 2025, these treasury bills will mature. And the expectation is that rates will be much lower by that time. Because if we have these rate cuts happening over the next 1 year, you expect that interest rates would have fallen at least towards the below 15% in a year's time. So investors with long-term obligations should instead of focusing on the treasury bill market, focus more on the long-term bond market. And then again, we've seen the consistent devaluation of the local currency on long-term portfolios. So one thing investors can do to balance out that risk is to allocate some of their holdings to the Eurobond market. But as we have seen with some of these sovereign debts or foreign currency debts, there's a lot of credit risk that comes with them. We've seen the default by Ghana. We've seen the potential issue that Kenya is facing. And then, of course, Zambia that also reorganized their debts, international debts recently. So it's important to factor in credit risk while allocating funds to foreign currency bonds. It's important to factor in credit risk going forward. And then, of course, I would say that for even the equities investment, investing in foreign currency carries its own risk, and investing internationally carries its own risk. Whether you're investing in the U.S. market, you're investing in a South African bond, a South African dollar denominated bond, it comes with its own risk, and one of which is currency risk. There's also political risk, and there's market risk. So investors need to be aware of all this risk, and then, of course, get guidance from a competent investment advisor.
All right. Thank you so much, Nathan. I'm just going to take a question from the Q&A box. Someone asked, what's the impact of tax on investments? According to the person, most financial experts don't talk about what the impact of tax is on their investments.
Okay, so I mean, that's a very good question, because tax has a profound impact on portfolios, especially if you're investing internationally. Tax has a lot of impact on portfolio, because what you care for as an investor is your after-tax return. Your return after adjusting for tax, inflation, and of course, execution cost. That is what investors care about. But once you start to invest globally, it becomes even more profound, the impact that tax can have on your portfolio. So whether you are investing locally or internationally, tax becomes very, very important. And for some investments are tax-free, like treasury bill, there are no tax implications. Government bonds, there are no tax implications. But especially when you're investing in the equities market, whether locally or internationally, there are tax implications. So whether you are trading regularly, there are capital gain taxes that you pay for returns on your stocks. Whether you're investing in the local market or in the international market, there are taxes that you need to pay. So investors need to be aware of this and pattern their trade in a way that is most tax efficient. And one way, again, is to invest with a long-term view. Most people who trade very regularly carry a lot of tax liabilities along those active trading strategies. But if you are investing with a long-term view, it kind of helps you minimize tax liabilities. My last comment will be that we do not have a perfect world. we do not have a world where there are no uncertainties. We will not see a world where we don't have political instability, where we don't have natural disasters. There are expectations of flooding in about 18 states in the country. That is going to maybe even lead to more food crisis for us as a country, and even worsen the inflation numbers that we're seeing. So there is really no perfect world. And the goal, how to live through all of this, is to look to the future and always think of long-term goals beyond the short-term sentiments.
That's a great message, Nathan. Thank you so much for that. Now, before we sign off, this mid-year report will be available for download on our website at www.savest-financial.com at the end of the webinar. Like mentioned earlier, click on the resources section and then on the webinar tab, and you'll get access to the documents. Alternatively, you can scroll to the footer of the website and see the webinar tab. You're going to find everything he talked about and then some. The report is definitely worth a read. Also, you can connect with an investment advisor or savers to go through it with you and pull out some of the key themes that may come from that. Alternatively, you can connect by scheduling a meeting on the Savest website. Just click on the Speak to an Investment Professional icon at the top left corner and schedule that meeting. Also, let me thank you all in our audience for your great engagement and questions today. Finally, let me thank you, Nathan, for your great insights. I hope everybody found this session as interesting and helpful as I did. So thanks again and enjoy the rest of your day.